on the left, calls and puts. In this case, the month is going to be listed right up here. And if you want to change months, you're going to click on the month that you wish to look at. Okay, this is an old screenshot. So yes, this when you see 12, that's 2012, August 12, September 12. Somebody tell me, this is the September 12 option. What day did that option expire? Can somebody tell me when did that option expire? It's September 2012. Tim thinks it was the third Friday of September. How many of you think that Tim is correct? The third Friday of September 2012. I guarantee you Tim's correct. Absolutely. What if that number changed? What if that number didn't say September 12, but rather it said September 2015? When would that option expire? It would still be the third Friday of September. It would just be the third Friday of September 2015. That's the only difference. I mean, this option chain is the same 2-3 years ago as it is today. This stuff has not changed. This is all the exact same stuff. Okay? Now, somebody has pointed out, all right, Gary, fine. Gary says it's the third Saturday, and Gary is technically correct. The third Saturday is when they actually expire, but you can't trade on Saturday. So the third Friday is the last trading day, and that's what we always call expiration day, is the third Friday. All right, I think you guys got it. I think you guys got this thing. Let's conclude our basics of options, and let me give you a basic strategy, and then that'll give us a good foundation as we move into level 2, okay? So here's my conclusion. This is just the basics. We're going to learn a whole lot more later. And what I want to do is now with that just kind of foundation, that's all it is. And please, 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 I know there's a lot of questions that you've got, but you realize that I could teach options. I do teach options straight through for 16 classes. So I can't compact everything into 2 classes here, but this is just a primer to kind of get you ready. What I want to do now is I want to give you a strategy that you can go make money with, and something that's not going to be super risky. Something that we call the covered call. This is a strategy that you can do with stock that you already own or stock that you want to own, and you're not going to take on any new risk than what you currently have. That's the benefit of this strategy. The benefit of this strategy is that you do not take on any new risk to what you've already taken on by buying the stock itself, and this strategy is going to pay you money potentially on a monthly basis, potentially every other month, every week. It just depends on how you do it. All right, the strategy is called the covered call. You saw a kind of an intro to this in the last class. This was the strategy that Bill did when he sold his covered calls for Goldman Sachs to Joe. Was it Joe? Forget all my examples here. All right, so in the last class, you saw this strategy at work. I want to uncover it a little bit and show you how you can use it here. You need to know some facts about this strategy first. First of all, this is considered one of the safest option strategies out there. And the reason it's considered one of the safest option strategies is because it does not incur any additional risk compared to just owning the stock. The only additional risk, if you can call it that, is potential risk of loss of upside potential. But outside of that, you don't have any additional downside risk. And because of that, pretty much everybody considers this the safest option trade that you can place. So it can be done with little, if any, additional risk. It can be used in most types of your personally managed accounts. Because of the low risk, a lot of your IRA accounts will let you do covered calls. For some of you, you may be able to allocate funds like in a 401k to do it. Any individually traded account, you can do it if you just turn on your option trading potential. Just activate that. So in other words, this is a strategy that pretty much all of you can do. It's a great little strategy there. It's a classic strategy of safer investors who want to make more money. There was a very famous stock teacher in the 1990s, a guy named Wade Cook. Some of you might have known that guy's name. And Wade Cook taught a lot built around the covered call. That was kind of his go-to strategy. And the real benefit of the covered call, the reason that so many people gravitate to it, is it's a way to make monthly income from your stock. And it's easy. I mean, pretty much any knucklehead can do it. It's an easy strategy. So let me talk to you about this. Now someone's going to be like, great, I can't figure it out. I'm a knucklehead. No, I didn't mean that. I'm just saying it's easy. It's just an easy strategy. All right, so here's how the covered call is created. You've got to own 100 shares. Gene, tell me, why would you have to own 100 shares if you want to do it? If you're going to go sell a call option, you got to sell an option contract. That contract has 100 shares. So if you want to do a covered call, it's got to have at least 100 shares. So you either have to own the stock or you got to go buy 100 shares worth of the stock. Now, after you buy the stock, you're going to turn around and you're going to sell a call option. Now, remember, the call option, if you're buying the call option is the right to buy the stock. If you're selling the call, then you're giving someone else the right to buy your stock. And in exchange for that, you're going to get paid. Now, you do become obligated to sell the stock at that price if they want to. But in exchange for that, you're going to get paid. That's the clincher. That's the silver lining. You're going to get paid to take on the obligation to sell. So let's do kind of just a basic example here, and I'll just draw this one out. So let's say I need some new guinea pigs. Let me pick on some different people here. Who have I not picked on? Ron. I hadn't picked on Ron for a while. Ron, you're my pick on for just a minute here. All right, so Ron comes in here, and we're going to pick a stock. We're just going to say he's trading the QQQ. Doesn't matter, but he's trading the QQQ, and right now the QQQ gets to kind of an extreme point here. And as we get on up here, the stock kind of starts to do this. Now, Ron purchased, we'll say back here. And I'm going to make some numbers up for us here. We'll say that Ron purchased at $100. And now the QQQ has traded to 110. Ron, if you were to sell at 110, how much money would you make? By the way, all of you can answer this question. Ron's going to sell at $110 a share. He bought at 100. He's going to make the difference of $10 per share. Does anybody not understand Ron's profitable trade? He buys here. He sells here. Everybody understands that, right? If he had 100 shares, he made $1,000. Yeah. Okay, but we'll keep it simple. We'll just use $10 per share. Okay, everybody's got that. Now, Ron decides that he's going to do one better. He's willing to do this deal. He knows he's going to make money on it. But Ron comes along and he says, I could do that. Or I got a better one. Ron says, what if I sell Joshua a call option? The call option is the right to buy the stock, and I'm going to sell those rights to Josh, and all my rights are going to go to him. And now I've drawn a hard line. I am willing and I am obligated to sell at 115 because I have sold Joshua the rights to buy my stock at $115 a share. In exchange for that, Joshua says, I will give you some money. And it turns out that the amount of money that Joshua is willing to pay for this is $1.05 per share. Now, what's the worst thing that happens to old Ron here? If the stock comes on up here, we'll do this in red. If it comes on up to 115 and it keeps going, Ron is going to sell his stock at 115 that he bought for 110 Sorry, he bought for 100. He's going to make a positive $15 per share, plus he's going to keep his $1.05. Ron's going to walk away from this deal with $16.05. Ron's making money. Ron's happy. Who cares what Joshua's doing? He bought the call option. That's his deal. You're Ron. You don't care. Now, what happens if the stock comes up to 115 and at expiration it closes at 113? Or it closes at 114.95. Well, Joshua's not going to pay 115 for a stock he could buy on the open market for 114.95. So what would happen is old Ron would keep his $1.05 per share. He keeps his stock, and he can turn around and do it again. I just explained to you in a nutshell the covered call. I'm going to explain it to you again, and I'm going to do it this time with a bunch of definitions on the screen. And we're just going to go over it again. And by the time we're done tonight, I want you to understand the principle, and then I want you to go practice it, because this is a way that you can get paid to own your stock. Okay? Now, Ron, in this particular case, was making money. He could have also used this strategy to lower his cost basis. Okay, but let's just go through it. Remember, the call option gives the buyer the right but not the obligation to buy or sell the underlying stock at the agreed upon price on or before expiration date. Joshua was my guinea pig for this one. So Joshua purchased the call option from Mr. Ron. The buyer, what did I just do to my screen? Crud. There it is. Go figure. The buyer of the call option has the right to buy the stock. Joshua purchased the right. Does everybody understand what Joshua got there? He purchased the right to buy the stock. He has the right to buy the Qs at 115 if Joshua wants to. Okay, the seller is obligated to sell it to him. In my example, Ron sold those rights to Joshua. He got paid for it. Now Ron doesn't have the choice. He cannot hold the stock until the stock goes to 145. Ron gave that right up when he sold Joshua those rights. But in exchange for that, he got the premium. Do you see how this could come right back to this picture of the Rosetta Stone? All you have to ask yourself is, what did I do? In this case, Joshua was the buyer, and old Ron was the seller. Ron is obligated to sell the stock at that price. Joshua has the right to buy it. Let's look at the benefits of this thing for the call buyer. In this case, we're going to pick on Phil because that's what my example on the screen says. So let's say that Phil decides he's going to buy a call option for a $90 call on Caterpillar. All right, let's look at the benefits here for old Phil. If the stock moves higher, Phil's call value is going to increase. If the stock moves lower, Phil's call value will decrease. Phil is in a straight directional trade. Phil's bullish. He wants and he needs the stock to move higher, or else Phil's going to lose money on this deal. That's the buyer side. Let's look at this for the seller side. Pablo, in my example here, because that's what I wrote on the screen, he's going to sell that $90 call option. If the stock goes up, Pablo's going to cash out at $90 plus his premium. That's it. If the stock goes down, well, Pablo's actually making money on that call option. Let's look at how this would work out. Stock moves higher. Pablo's call will increase in value. Consequently, who was the other guy? I got off. Phil. Phil's going to probably come back and buy it. If the stock moves lower, Pablo's call is going to decrease in value. So in this case, Pablo's trade is somewhat bearish. He wants and needs the stock to move down. So think about selling a call option kind of like you would think of selling a short stock. You need the stock to go down, and as the stock goes down, the call value will go down, and you're going to make more money on it. You need the value of the option to go down in order to realize the full profit. That's the way that this is going to work. So how could this turn out? Well, there are three outcomes. The stock could go up, it could go down, and it could go sideways. And if you were like this girl, you stick your finger to your mouth and you wonder, which way is it going to go? Stock goes up, there's one outcome. Stock goes down, there's one outcome. Stock goes sideways, there's an outcome. Let's look at them. If the stock goes up, Pablo has his shares that he purchased at $82.65. If the stock goes up, remember Pablo sold his call for $90. And Pablo will realize 100% of the premium from the call that he sold. I didn't put a price in here for that. We'll just say that he gets whatever his premium is. He will be called out of the stock at 90. In other words, he's obligated to sell at 90. If the stock goes up, he's planning to do that. His profit will be $90 minus his entry price of $82.65 plus his option premium. This should be in your notes. So in this example, Pablo would have a profit of $7.35 plus his option premium. If Caterpillar reaches $90, Pablo has reached the maximum profit that he can get. If the stock trades above 90 but drops back below before expiration, he will keep the stock, but either way, he keeps the premium. Either way, he keeps the premium. That is a guarantee. How many of you like to do business when you have a guarantee of something? That's taking the money that's on the table. Now, let's ask the question from Pablo's perspective if the stock goes down or if the stock goes sideways. If the stock goes down or sideways, Pablo will keep 100% of the premium. As long as the stock closes at or below $90 at expiration, Pablo will not be called out and he will maintain ownership of the stock. His profit will be 100% of the option premium, and he still owns the stock so he can turn around and do it again. Kind of like renting your house. Have any of you ever done a lease purchase on a house where you have a renter in there and they're renting it from you, and if they decide to buy it, they've locked in the price, but if they walk away, you collected all the rent and you keep the house? That's it. It's the exact same deal. It's a lease purchase on a stock. How many of you think this could be a pretty cool little strategy for you? Let me roll through some FAQs. How many shares must you own? Well, remember, options are written in contracts of 100 shares, so you've got to have at least 100 shares. If you own 100 shares, you can write one contract. Joshua, tell me something. If you own 151 shares, how many contracts can you write? You own 151 shares. You can write one covered call. You own 199 shares. How many contracts can you write? You can write one. You own 204 shares. How many contracts can you write? 2. You guys are smart. Every one of you. You can do this, I promise. I told you a knucklehead can do it. All right, who keeps the dividends? Michael, what do you think is going to happen if this stock, you've sold a covered call on it, but you own the stock? Who's going to get the dividends? Well, that's a good question. You didn't think about that. Who keeps the dividends? Well, you do. As long as you still own the shares, you're still eligible to receive the dividends as long as you still own the shares. Now, if you get called out and dividends are paid after you sell the shares, you don't get the dividends. But if you still own the shares, when the dividends are paid, you will get the dividends. Okay? By writing the call and making money while you're still collecting dividends, I think you're maximizing the profit. That's why I call this the ultimate dividend. Okay? Now, Earl wants to know what happens if the stock goes to 200. Earl, I'm not sure which stock we're talking about. I think we're back on Caterpillar, so this was a $90 thing he bought down here at 82 something or another. Earl wants to know what happens if the stock goes up here to 200. I don't know, Earl. You sold You sold somebody a $95. No, we did a $90, didn't we? Sorry. You sold a call at $90, Earl. Somebody else has the right to buy it at 90. You are obligated to sell it at 90, Earl. What do you think's going to happen if the stock goes to 200? I think you can answer this question yourself. Are you going to be required to sell it at 90? Or do you get to sell it at 200? The buyer of the option, Edmund says the buyer of the option did well. The buyer of the option did well. And Earl is going to be selling at 90. That's right. That is, if there's a downside to this strategy, that's the downside, is that you cap your upside. Okay? Let's think about it this way. When you buy stock, you have a limited downside and an unlimited upside potential, right? If you sell a covered call, you have a limited downside and you have a limited upside. The stock can only go down to 0, and your upside is your strike price. I teach all of this stuff here in my Options Made Simple program, the more advanced options program, but that kind of helps you out there. There is a downside to every action you do. With options, there's an upside and a downside to every trade. But every investment has that. And this is just basic investing. Okay? John wants some clarification on the dividends. He says, which date determines who gets the dividend? If the dividend is paid out, John, before expiration, you're going to get the dividend. If the dividend is paid out after expiration and you get called out of the stock and sell it, you're not going to get the dividend. You can turn around and buy it at stock again and get the dividend, but you got to buy it again. If the stock you own goes down, you'll also lose money, but the premium will offset a little. That is correct, Anthony. You would lose equity value. You would lose some equity, but if you didn't close the trade, if the stock went down, then you would not. You'd lose equity is what you're losing. Brian wants to know, how far into the future would one sell the option? I haven't told you that, Brian. We'll get there. Okay. Oh, that's a great question. Joshua wants to know, curious, when a stock reaches the strike price, can and will it be exercised before expiration? Can it? Yes. Will it? Maybe. Yes, it can be exercised by definition anytime on or before the expiration. Remember the definition? The right but not the obligation to buy or sell, that's a call or a put, a specific stock at a specific price on or before the expiration date. So Joshua, yes, it can be exercised before expiration. Now, will it? In my experience, and this is getting a little bit more advanced, in my experience, if you're only 1 or 2 strike prices in the money, fairly low probability. If you are deep in the money, fairly high probability. If you have very high liquidity, meaning there's a lot of open interest, lower chance of being exercised. If you have very low liquidity, much higher chance of being exercised before. Okay? All right, let's talk about capital. How much capital is needed? Well, every trade's different, so here's the formula. Stock price times 100 equals 1 contract. However many contracts you want to buy to sell, you're going to need to multiply the stock price times 100. That gives you the capital requirement to go out and do 1 covered call. Okay, so every trade's different because you're going to have to look at the cost of the shares. Now, what's the risk? Let's talk about the upside, the downside, and the dark side. The biggest risk of selling/writing a covered call is that, as somebody mentioned a few minutes ago, was it Anthony said this just a few minutes ago. The risk is that the underlying stock would decrease in value and you would lose equity. That is a legitimate risk. You also realize that you've already taken that risk if you already own the stock. So you're not taking on any new risk. You already have that risk. And out of curiosity, how do you think you could protect against that risk? Just if you had to guess, Anthony. And I know I haven't taught you advanced options yet, but you could go buy some puts, couldn't you? You could go buy puts and you'd protect yourself. So there are ways, Anthony, that you could offset that as well. There's another risk, and the other risk is the theoretical risk, and that is the risk of potentially missed capital gain. Okay, now that is, as Earl was asking, what if the stock goes to $200? I miss all my capital gain. And Earl, you're totally correct. If you're required to sell at your strike price, then you're going to miss your capital gain. That is the downside. You give up the upside potential for a guaranteed profit that you're going to get regardless of what happens with the price of the stock. And as Anthony pointed out, you can use that to lower your cost basis because you're keeping that money. So here's how we figure some profits here. Here's your formula. The strike price minus the stock purchase price plus your option premium equals your maximum profit. All right, let's call it a class. Just kidding. I'll break it down. I wouldn't leave you like that. That was mean, wasn't it? All right, strike price minus stock purchase price plus option premium equals maximum profit. If, hypothetical world, if you sell a strike price at 90 and you purchased the stock at 82, your profit is 8 plus your premium. If your premium was $1.90, your profit is $9.90. Does that make sense? That formula works every way you twist it. Strike price minus stock purchase price, that's your profit on the stock deal, plus your option premium, that equals your maximum profit. All right, let's do another one here. We're going to go sell a $140 call option on the Spiders. We're going to buy the stock at $138.47. Okay, so let's go over to our option chain. We're going to walk all the way through this now, Anthony. We're going to sell the call at a 140 strike price. We're going to buy the stock at 138. If you go sell the call option, you're selling someone else the right to buy, and you are getting the money. You're selling the rights to buy. You become obligated to do what, Anthony? Obligated to sell. Okay, so let's watch how this thing's going to play out. We're going to sell the 140. We're going to buy the stock at 138.47. Here's your option chain. You got 3 strike months that I'm going to give you the choice to do here. We can go do the 140 and make 47 cents per share for the weekly. Okay, we can go do the August 12, bring in $1.17 per share. We can go do the September and bring in $2.44 per share. Let's just pick the middle one. Let's say we're going to do the August and we're going to bring in $1.17. By the way, that's about 2 weeks to expiration. Somebody asked how far to expiration. Well, this one was about 2 weeks out. Okay, so we spent $1.38.47 per share for the stock, and we bring in $1.17 from the option premium. Now we are obligated to sell the stock for $1.40. Are you tracking with me? Okay, now let's do some additional math. Remember, you bought the stock at $138. You sold the 140 call for a premium of 117. You're now obligated to sell at 140. Strike price minus stock price plus option premium equals max profit. Here's the formula. 140, there's your strike price, minus the stock price of 138.47. That's the stock price, gives you $1.53, plus our $1.17 option premium is a $2.70 per share maximum profit. If the stock goes up at or above 140, you've reached maximum profit. Anything above 140 is max profit. Anything below 140, you've got the guaranteed $1.17, and you're making whatever equity profits there. If you drop below your 138.47, you start to lose equity value in your option. Or sorry. Equity value in your stock, not the option, in the stock. You tracking with me? Now let's look at what's just happened here. By the way, this was how far was this to expiration? How long do you remember? 16 days. 16 days is not very long. If you invest $138.47 per share and you bring in a maximum profit of $2.70, that's 1.9% profit in 16 days. If you did that trade on margin, which means you put up half the money and your broker put up half the money, that would have been 3.8% profit in 16 days. You can turn around and do that again in 16 days. Either you cash out, you make the 3.8%, turn around, do the whole thing again, or you take the premium, you turn around and do that again. Now, I realize 3.8% doesn't sound that exciting until you start running the numbers. Dan, what would happen if you did 3.8% every month? This was in 16 days. What if you did it every month? What would your return be at the end of the year? What if you just did 2% every month? What would your return be at the end of the year? You see, a lot of people look at this trade and they think, well, that's not a lot of profit. I'm limiting my upside. I got a maximum profit, blah, 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 blah. And they're missing the fact that this provides consistency. People get turned off by the max profit part of this. Earl, that's what you were seeing. Earl was saying, well, what if it goes to $200? I'm limiting my profit. Yeah, you're turned off by the max profit part. The benefit is not the maximum profit. The benefit is the minimum profit. Let's look at this as a minimum guaranteed profit. You ready for this? Watch this. So remember, we sold the 140 call, having bought the stock at 138. We got the premium of $1.17. We've got a minimum profit of $1.17 per share. That's 0.8% in 16 days. It didn't take us a year, 16 days. That's about what you're getting in a year at the bank, and we did this in 2 weeks. So if you were to multiply that out every couple of weeks, every, say, 2 or 3 weeks, and you got the minimum, you're lowering your cost basis of the equity that you do have. You're bringing cash in. You're minimizing some of that exposure there. And it's the minimum that's the attracting part to everybody. The maximum, yes, that's the downside. But this is a guaranteed income because once you sell that call, you're guaranteed that cash is going to come in. Let's do another example here. This was a fairly low volatility trade, so it's a fairly low ROI. Let's do another one here. This was for Baidu. And in this particular case, Baidu was trading at 122.59. So let's do the same trade, just a stock that has a higher volatility so you can get more premium on it. Baidu selling at 122.59. Let's go sell the 125 call option for $2.45 a share. Okay? Well, let's do the math on that. Your max profit is your strike minus your stock. Max profit is $2.41 plus your option premium, $2.45. So your max profit on this deal is $4.86, $4.86 or 3.9% ROI in 16 days. Multiply 3.9% ROI in 16 days out over the course of a year, and you're starting to look at returns that look a lot like a hedge fund manager. By the way, that's why so many hedge funds like to use this strategy, because this is a really good strategy. And it's relatively low risk, comparably speaking. Now, what's the minimum profit on this? If all we made was the option premium of $2.45, you're still going to bring in $2.45. That means you're lowering your cost basis by 2%, or you are bringing in cash of 2%. Depends on how you choose to look at it, but you're bringing cash in. So even if your equity goes down, you've lowered your cost basis. You could sell this stock for $2.45 less than you bought it for and still break even. What if we made this deal a little bit more involved? What if we went out and we didn't do 16 days to expiration? What if we went out 51 days to expiration? Look at the numbers. Holy cow. We still have the $2.41 per share profit if we're selling the 125 strike price, but that option premium's jumped up to $5.45. We've got a maximum profit now of $7.86, which is an ROI of 6.4% in 51 days. Some of you would be thrilled to get 6.4% in a year, and this is in 51 days. And your minimum profit was 4.4%. This was a real trade. This is not a gimmick trade. These trades are out there. They're frankly, quite frankly, all over the place. This is a guaranteed minimum income. You keep the equity in the stock. If you sell the stock, you sell it for a profit if you've written this right. And if you don't sell the stock, you keep the stock that you were wanting to hold anyway, and you make some extra income. This is pretty cool, isn't it? Now, let me ask you a question. How many of you are trading shares that you trade for dividends, and you're looking for that, maybe the annual dividend? Anybody here trading shares for dividends, and you're looking for that annual or maybe quarterly dividend? Okay. What if you could double down on that? Because I've already shown you that if you own the stock still, you can sell the covered call and still collect the dividend. So what if you sold a call option maybe every 2 to 4 weeks? And what if you only made 1% and you collected the dividend? For some of you, your dividends that you're collecting are only 2 or 3%. What if you did 1% a month? That's 12% a year, plus your regular dividends that you collect. Do you see why I call this strategy the ultimate dividend? If you do this right, you just keep printing money. It's pretty darn cool. So here's the applications for the covered call. You can use it as a cash flow tool. You can use it in a bullish trend, and you can use it in a bearish trend. We'll walk through each of these, and then we'll wrap it up tonight. As a cash flow tool, when the market stagnates or it moves sideways, it becomes difficult to make money buying and selling stock. So you can sell a covered call. That's going to bring money in while the market's stuck. This is an ultimate dividend. You're making money while the market's stuck, and you can still collect your dividends. Pretty cool. In a bullish trend, you can use the covered call to help capture some profits up front. And if you sell the call as you're kind of hitting a peak, like we're doing right now in the market. Right now, we're kind of hitting some peaks. So if you were long, maybe spiders or Qs or diamonds right now, this would be a good time to go sell some covered calls on that. You collect some premiums up front. You either sell the stock at a premium, a little more than you were expecting to sell it for right now. You're willing to get out if you had to. But you collect the premium on the covered call. The stock cycles down a little bit. You collect that premium. You can turn around and keep holding the stock. In a bearish trend, we can use this when stocks are falling to recapture our capital. And we can use it to lower our cost average while we maintain our equity. That's pretty cool. Now, let me give you kind of a formula for how you can implement this. Somebody asked earlier, I forget now if it was Anthony or who it was, but here's the formula. Sell a call option 1 or 2 strike prices higher than your stock purchase price. If you do that, you're not going to lose money on the stock. If you sell a strike price below your stock purchase price, you could lose money on that. So you don't want to do that unless you're prepared to take that hit. Sell the call option 1 or 2 strike prices above the stock price. You can sell a weekly, you can sell a monthly option, you can sell further in the future if you want to. I suggest you sell 2 to 5 weeks into the future. That's how much time till expiration I suggest. There's a reason for that. That's where your time decay is going to maximize for you. We'll get into that in more advanced classes, but this is your basic checklist to get you going. Okay? 1 or 2 strike prices above the stock price. Sell a weekly or monthly or even further into the future if you want to, but I suggest 3 to 5 weeks, 2 to 5 weeks. Just remember you're tied down until your option expires. You can release that if you buy it back, but you'll probably lose some money on that. All right, let me kind of see how you guys are doing. I know I've gone through a lot of stuff. How are you guys feeling? You guys feeling pretty good? We started tonight's class, and I asked how many of you like to own stock and how many of you like to own it for intermediate or long term. And I was going to show you some cool ways to maximize that. How many of you feel like the covered call, if you took some time practicing this and you kind of got better at it, how many of you feel like this would be a strategy that I could make some extra money on consistently? I know that this is a strategy you can make some money on consistently. You need to go practice it. You need to work out some of the details just a little bit. But this is a strategy that when you learn to implement it and work it, it will put money in your bank account literally every month, sometimes every week, depends on how you decide to implement it. Here's your homework. Buy at least 100 shares of stock in your virtual account so you can turn around and do a covered call on it. And then I'd suggest you do 4 or 5 of those trades in your virtual account just so you can kind of get it under your fingers and start watching your account cash go up. As soon as you start selling those covered calls, the cash in your account will go up immediately. So that's pretty cool.